Hey everyone, it's Eric from Option Edge, and in today's video, we're going to talk all about calendar spreads. We're going to go over everything you need to know to trade calendar spreads effectively. Let's get into it. All right, folks, it's Eric with the Option Edge, and in today's video, we're going to be going over everything you need to know about the calendar spread option strategy. So let's get into it.
All right, guys, before we start this video, I want to give you just an overview of exactly what we're going to be talking about, and I'm going to have the timestamps to each one of these points in the notes, so you don't have to listen through a 15-minute long video. You can jump right to the section you want to look at. So first and foremost, we're going to have the formal definition of a calendar spread with an example. We're going to discuss max profit, max loss, and break-evens of calendar spreads, how volatility affects your profitability, and how the mechanism behind how calendar spreads profit, calendar spreads, what their delta is, what type of delta positioning we have with the calendar spread. We're going to talk about theta decay. We're going to talk about optimal profit targets, and then we're going to talk about some of the risks like expiration, gamma assignment, and dividend risk. And then we're going to talk about how to adjust the calendar when it moves against you, and the best time to open a calendar spread, the best environment to open a calendar spread. And then lastly, I'm just going to talk real quick about at-the-money calendar spreads, which is going to be in the first example. And then we're going to talk about directional out-of-the-money calendar spreads. Alrighty, let's go.
So what is a calendar spread? A calendar spread is a strategy involving buying a longer-term option contract and then selling a shorter-term option contract of the same underlying stock or index with the same strike price, okay? So let me show you right now in a brokerage account what that's going to look like. Let's go. All right, we're in the Robinhood trading platform, and we've opened up Apple's options chain. So to make a calendar spread, we're going to need two sets of contracts in two different time periods, okay? So we're going to start with the front month option, which we are going to sell to open, okay? We're going to select a call, and we're going to sell to open, and we're going to select the at the money 155 call, okay? And then we're going to go and pick a different date, which is going to be the back month, meaning the longer dated option, which is going to be, I'm going to choose the May 19th, which is the month of May's expiration. And then we're going to switch from sell to buy, okay? And we're going to select the same call strike, the 155 strike. And now what you're going to see is we've created this little tent profit and loss diagram. It's a net debit, so it's similar to any other type of debit spread, but it is a calendar spread. So let's talk about break-even points, max profit, max loss, etc. So let's talk about max profit first. You can see the Robinhood platform calculates the max profit to be $2.65 and 2.27 cents. That's if we pin the 155 strike right as the front month option expires. Something to keep in mind about the max profit number is it's actually an approximation. So Robinhood defaults to calculating the max profit using the current implied volatility. So that sounds a little confusing, but all you need to know is that you could make more money if volatility increases because the back month option will be worth more, and you can actually profit less money if volatility decreases because the back month will be worth less. If you're a net buyer of options, volatility increases will increase the premium in the options, and vice versa if your premium decreases. Break-evens are also approximations. If volatility was to rise, break-evens would increase, but it gives you an approximation of the break-evens given the current volatility if volatility was to stay constant. So you can see we are at 161, almost 162 to the upside, and 148.78 to the downside. In terms of max loss, it's going to be the debit paid. Like I said, this is a debit spread. It's another type of debit spread, and you can only lose the price paid. Okay, so real quick, I switched over to the Tasty Trade platform because I want to show you the effects of volatility on the P&L diagram, which I cannot show you in Robinhood. So this strategy is the same one we had on Robinhood. I have the April 21st 155 calls that I'm selling with the May 155 calls that I'm buying. Let's go to the analysis page. All right, so let's start changing up the volatilities and some timing. So what I have here is at the expiration of the back month option. This is the P&L graph. So you can see this is a different
theoretical P&L compared to Robinhood, it says $319 as what the max profit would be. So let's go ahead and change the volatilities around and see what if we can increase or decrease this max profit. So you can see here expiration implied volatilities. Let's take the back month option. This is the May option, and let's increase this sucker. Let's do like, let's see, 10%. Okay, so we went for like 34 to 44%, and let's take a look. All right, now look at our P&L. So it is now 489 versus like 300 plus. So you can see that not only is the max profit also bigger, but as we increase the volatility, our break evens also expanded. Now let's take a look at what happens when we decrease volatility. So I reset volatility to what it's currently at, which is 34. Let's decrease volatility 10%. All right, so a decrease in volatility results in a max P&L of only about 150, and you can see our break evens are vastly smaller. So volatility matters. Okay, the next thing I want to talk about is how this trade profits. So by looking at the profit and loss diagram, you can see that this trade profits if we stay in this range, which is about $10, okay? A little bit over $10. So if the stock doesn't move, you're going to make money. If it moves a little bit, you're going to make money. In addition, if the volatility expands, meaning we have an increase in volatility, the calendar spread will be worth more. This is a delta neutral, non-directional play. Something that's counterintuitive is usually higher volatility levels is tied with extreme price movements. Something else to keep in mind is how longer dated options are affected by volatility. So the longer dated the option, the more sensitive to volatility it's going to be. So that means your front month option, the April option, is going to be less sensitive to rises in volatility than the back month option. If you get an increase in volatility, the back month option will experience more price appreciation than the shorted dated option. And we can look at that based on the options contract's vega value. Let's take a look. So the front month options contract's vega is 0.1873. Let's now look at the vega of the back month. So as you can see, the vega value of the back month option is a larger absolute value. Therefore, it's going to be more sensitive to volatility. Basically, what vega means is for every 1% increase in volatility, this contract is going to appreciate 25 cents. Another thing I wanted to show was how theta decay affects the profitability of a calendar spread. So basically, here's the mechanism. The shorted dated options experience faster time decay rather than the longer dated counterpart. So you can see this is our back month option, the longer dated option, and then this is our shorter dated option. What's going to happen is it's going to experience a faster theta decay and it's going to exponentially drop off. And as time goes by, if the stock stays near the strike price of the calendar spread, what's going to happen is the shorter dated option's going to totally decay, and then the longer dated option will decay a little bit, but it's going to hold a lot of its value. And that's how you get max profit, basically. All right, we're back in the Robinhood trading platform, and the reason why is I want to show you the differences in theta between options of different contract dates. So here's the April 21st is what our front month option has been, the 155 call. Let's look at theta. So theta is 0.09. All right, so now let's go to our back month option. So we're in the back month, the May expiry, and let's take a look at the theta values for the same strike, but just different date. So you can see theta is 2 less. It's 7 compared to 9. So the theta decay of our back month option is going to be slower. Okay, moving on. So a couple things I want to talk about is one is the profit target, and then two is how to adjust this trade if it moves against you. So as far as profit targets go, I aim for a 20 to 30% profit target, and that's a good rule of thumb that I've learned from other traders, and you can experiment with what works best for you. And one of the main reasons why you don't want to wait till the very end of this trade to come to full profit is because let's say you do get very close to that 155 strike at expiration, there's going to be a hell of a lot of gamma risk, and you can get stuck in a situation where if the stock doesn't
quite land right on 155. If it lands, let's say, right above 155, you're going to get assigned that stock, and that's sort of a headache, and it's best to close out early before expiration. In addition, if you wait too long and the stock takes a drastic move up or down, and especially if it's a call calendar spread and your short call strike ends up getting in the money, and there's a dividend due, you might have to pay out that dividend. So another rule of thumb is don't place calendar spreads while the underlying stock is going to go ex dividend. And as far as adjusting the trade, let's talk about a hypothetical situation where the stock gaps down really low, really quick. So what's going to happen is you're going to see a fast decrease in your front month option, but your back month option is also going to decrease, which we do not want. We want in a perfect world, we would have the short dated option go to 0 and our longer dated option go to infinity. But in this scenario, both contracts are going to reduce in value. So one thing you could do is, let's say we close this out for a total hypothetical credit of $5.80. We received it all, and we can then roll back and out in time and go from selling the April options to selling the 160, as long as we can do that for a larger credit. This is hypothetical. Every situation is different, but you're able to maybe roll out in time. Moving on. So what is the best calendar spread environment? That's going to be in low volatility environments. And the main reason is you're going to benefit from implied volatility expansion. You wouldn't want to do this in a high implied volatility environment because the debit spread will decrease in value if there is a drop in implied volatility. And since implied volatility tends to be mean reverting, meaning once it is increased, it tends to revert back to the normal levels of lower volatility, then that's going to be a losing strategy overall. So you want to stick to low implied volatility environments to put on calendar spreads. Okay, so far I showed you an at-the-money calendar spread using calls, but let's say you have a directional bet on where the stock might go. So let's say in the next 60 days, you think Apple might be between 130 and 140-ish, so you want to sell the 135 put calendar spread. So max profit would be at the 135 strike. So let's see how we can use a calendar spread to benefit from a directional move in the market. So we're back in the Robinhood platform. So let's pick out our contracts. So the back month option is always going to be the option contract that you buy, because this is going to be a debit spread, and the back month option will always be more expensive than the front month option due to the time premium that you're paying for. So our directional bet is going to profit the most if the stock lands right at 135 at the expiration of the front month. So we're going to buy the 135 put, then we're going to go to the back month option and sell the put at the same strike. Now you can see the debit paid is going to be far less than what it was before, because we were purchasing and selling the at the money options. The out of the money options are going to be priced less because there's a lower probability of the stock moving that far. But you can see that the risk to reward ratio is actually quite large. It's over 4-to-1, with max profit being around $400+. And of course, our max loss is going to be the debit paid, about $1.30. And last but not least, there's another type of calendar spread, which is actually called a diagonal spread. And this is how we can set it up. We're going to take the shorter dated April option, and instead of selling the same strike, we're going to go further out of the money to make this trade more directional. So we're going to select the 130 to sell. And as you can see, this trade can profit from a move to the downside. And if the stock continues moving to the downside, you will still make money, unlike with calendar spreads. After a while, if the stock moves too much, you will start to lose money. This is a quick intro to diagonal spreads. I'm not going to say anything else. Just wanted to introduce this concept in addition to regular calendar spreads. And that's really it for what I have to show you today. I hope you guys liked it. Please comment any questions or any ways. Please comment or give me any advice on how to make these videos more engaging and less boring, hopefully, and dry.